While some people believe the health crisis will soon disappear, others can be overly anxious about how long it's going to last and how deep the consequences of this outburst could hit them. A number of Americans are already feeling a hint of the weight of this economic crash on their backs. And in this video, we're going to assess the imminent real estate crash that is concerning many of them. The stock market crash has made investors and home buyers discouraged and wondering if the housing market isn't the next piece in this domino effect fall. As stated by a survey done in April by the National Association of Realtors, 90% of their members affirmed the current outbreak has considerably decreased home buyer interest. More than half of the clients decided to postpone their purchase until the situation calms down a bit more. Two-thirds of them are expecting lower prices. According to a recent publication on the Balance's website, there are 10 warning signs that can help you predict an incoming crash. Using this list as a base and adding guidance from the data we collected from renowned web portals such as Investopedia, RateHub, and PR Newswire, we are going to explain how every one of these aspects can contribute to a collapse in this market on a greater to a lower extent. Asset bubbles bursting. Now, usually crashes like that take place when an asset bubble bursts. A red flag for an inherent bubble is the sudden boom in home pricing. On the authority of the Case-Shiller Home Price Index, by January 2020, the national average home price hit a record high of $212,433. That's 15% higher than July 2006 record high of $186,613. Likewise, the S&P Home Builders Select Industry Index has climbed drastically from 1,372.6 in October 2011 to 4,867 in February 2020, setting a 250% raise. However, it has dropped by half to 2,486 in March 2020. James Stack from Stack Financial Management declared in an interview with MarketWatch that he used the Housing Bellwether Barometer to predict the 2008 financial crisis. This is an index he created to assist home builders and mortgage companies. In 2017, it skyrocketed just as it happened in 2004 and 2005. Increase in unregulated mortgage brokers. As it's affirmed by RateHub website, the regulated mortgage market is constituted by bank and monoline lenders, which are federally regulated. Regulated creditors are supervised by the Office of the Superintendent of Financial Institutions, OSFI, so they must follow the rules established by OSFI. In contrast to the regulated mortgage market, the unregulated market is made of mainly by private creditors that can be companies or individuals that are out of the reach of the national banking regulators. Private lenders offer higher mortgage rates than conventional lenders, usually short-term loans at rates above 7%. Usually, people turn to private lenders for short-term mortgage loans if they can't normally qualify with banks or alternative lenders for the A or alternative mortgage space. Currently, it's become more important than ever to address the sudden growth of the unregulated mortgage market. It's harder than ever to qualify for conventional mortgages due to the increased mortgage regulation, and as a result, more people are turning to the unregulated mortgage market and their loans are becoming pricier and pricier. In 2018, they generated 53.6% of mortgages in the United States. 5 of the top 10 mortgage lenders aren't banks anymore. This can make them more vulnerable to a collapse if the housing market crashes again. Rising interest rates. Generally, a slow and steady interest rate increase won't create a catastrophe, but a sudden boom in rates is more likely to do so because higher interest rates make loans more expensive, and consequently, it slows home building, decreasing its supply, and also slowing lending, which reduces demand significantly. The Fed has lowered interest rates to 0 to assist business owners with the economic crisis. and that should help the housing market too. But if we analyze how interest rates have been rising preceding the housing collapse of 2006, when many borrowers had interest-only loans and adjustable rate mortgages, and many also had introductory teaser rates that reset after 3 years, when the Fed raised rates at the same time they reset, borrowers found that they wouldn't be able to afford the payments anymore. Home prices had dropped. Mortgage holders couldn't pay for or even sell the house, leading to huge default rates. This showed us the Fed raised rates too fast between 2004 and 2006. The top rate was 1% in June 2004 and doubled to 2.25% by December. It doubled again to 4.25% by December 2005. 6 months later, the rate was 5.25%. Since 2015, on the other hand, the Fed raised rates at a much slower pace. Moving on to inverted yield curve. Another warning alert for the housing market is when the yield curve on U.S. Treasury bills reverses. An inverted yield represents a scenario where long-term debt treasuries have lower yields than short-term debt treasuries of the same credit quality. As it's explained by Investopedia, a yield curve is a graphical representation of yields on similar bonds across a variety of maturities, also known as the term structure of interest rates. Normal short-term yields are lower because investors don't require a high return to invest for less than a year. When the yield curve inverts, short-term interest rates become higher than long-term rates, which means investors think the short-term is riskier than the long-term. This type of yield curve is the least common of the 3 main curve types and is used as a way to predict an economic recession. Now, the yield curve inverted before the recessions of 2008, 2000, 1991, and 1981. Due to the unusualness of yield curve inversions, they normally draw attention from all parts of the financial world. Changes to the tax code. The real estate market tends to react assertively when Congress changes the tax code. It's said that Trump's tax reform plan could have a negative impact on housing. The real estate sector is opposed to this tax plan, which raises the standard deduction so that many Americans no longer need to specify. Consequently, they can't take advantage of the mortgage interest deduction. Banks return to using derivatives. Economists alert that the real estate market can collapse if banks and hedge funds return to investing in risky financial products. These derivatives were one of the main causes of the financial crisis, you may remember. Banks had cut mortgages down and resold them in mortgage-backed securities. These bonds were a bigger deal than the mortgages themselves. Then, banks sold mortgages to literally anyone because they needed derivatives to be supported. They cut them so that bad mortgages were hidden in groups with good ones. Therefore, when debtors defaulted, all derivatives were suspected of being bad, and this very episode led to the disappearance of Bear Stearns and Lehman Brothers. Increase in flipped homes. Almost 6% of all home sales were bought for quick resale at the end of 2019, differently from the post-recession high of 7.2% on its first trimester. The so-called flip homes were meant to be purchased, rehabbed, and resold in less than a year. Todd Tater, Chief Product Officer at Atom Data Solutions, reported that home flipping profits across the U.S. dropped again in 2019 as the business of buying and selling houses absorbed its worst year since the housing market was mired in the fallout from the Great Recession. This happened as the cost of buying properties continued to rise faster than gains on resale, which made clear for realtors that this dramatic downfall is a sign that the housing boom may face a countdown. Affordable housing plummets. In addition to all these factors, there is an ongoing fall in affordable housing. Cities are having the worst shortage due to soaring home prices. Between 2012 and 2017, housing costs have increased by 30%, while wages have only risen by 15%. By the end of 2017, only 39% of rental units in the U.S. were affordable for low-income households. That's a 55.7% drop compared to 2010. The city population has climbed by 14.5% between 2010 and 2019. Now that's a lot faster than the national average of 6.3%. Rising sea levels. A collapse is predicted to happen for real estate markets in coastal regions that are susceptible to the impacts of rising sea levels. It's estimated that by 2045, approximately 300,000 coastal properties will flood at least 26 times per year, summarizing a total cost of $136 billion in real estate. This can interfere in the valuation of 30-year mortgages that are being made right now. Experts believe by the end of the century, 2100, 2.5 million homes worth $1.07 trillion will be at risk of chronic flooding, and properties located on both coasts are at most risk. During high tide, the streets are flooded by the ocean in Miami. According to a Harvard survey, house prices in the lower areas of Miami-Dade County and Miami Beach are slowly soaring in comparison with the rest of Florida, and properties at risk of rising sea levels are sold at a 7% discount to comparable properties. The Balance's article claims that most residencies in these cities are financed by municipal bonds or home mortgages. Their destruction would definitely hurt investors and depress the bond market that could lead to a real estate collapse in these regions, especially after severe storms. Finally, officials warn of a housing crisis. William Poole, the former president of the Federal Reserve Bank of St. Louis, warned in an editorial of 2017 about another subprime crisis. Poole was the head of the Federal Reserve Bank of Kansas, who warned of the subprime crisis in 2005. He says that 36% of Fannie Mae's loans required mortgage insurance, a similar rate from 2006, which indicated that the recession was about to come. With this list, we can see from many different angles the possibility of a real estate crash sometime soon. All the conditions seem to be adding up to an eruption on many fronts. There is another outburst about to form.